Welcome back, investors, to Ticker Time News. I'm Adam, and semiconductor stocks have been falling hard over the past few sessions, actually over the past several weeks and pretty much most of the year. AMD kicked it off last week with additional pain, but Nvidia kind of kicked it off first. But AMD last week introduced more pain into semiconductor stocks and the semiconductor ETFs because it lowered its guidance. Then in the after hours trade today, Applied Materials is a new culprit for pain. Ticker symbol AMAT for Applied Materials. Let's go there. Before we do, real quick, right here on the screen, this chart is for the Van Erik Semiconductor ETF. Ticker symbol is SMH. You can see there the past several sessions, and I should have had my Sharpie all ready to go. Right here, the past few sessions have been straight down practically. Now, this isn't very good for semiconductor stocks and those in it, but I would like to back up one quick second and go to AMD. Before we go to Applied Materials, let me go to AMD. We talked about AMD towards the end of the live stream yesterday and a couple days prior to that. And I want to point out here on the 5-minute chart. All right, loading up the 5-minute chart. Got to press a magic little button here on Trading View. Right here, this undo, so we can see this. Okay, I'm going to put the last 3 trading sessions on the screen here, and voila, there they are. The first 2 or the last 2 trading sessions have these blue trend lines underneath, right? We start low in the morning, we rise through the day. We start low in the morning, we rise through the day. Today, we did the same thing, but at a little more, I would say, aggressive pace. Let me put this trend line on here. Today's low, just like the past 2 sessions, and then we're going to go up to the high of the day, which was right there. Now, it's not much, but it is noticeable that today's incline from that trend line is a little more steep or a little steeper than the past 2 sessions. Now, what I said yesterday about this kind of formation here of a low start in the morning, an acceleration and ascension throughout the day, looks to me like the pain, the falling, is coming to an end. And if we back up even further to catch AMD's fall from last week, you can see that it was substantial. Now, today, in my mind, only solidifies that this is a bit of a, at least local bottom for the time being for AMD, okay? With Applied Materials news in the after hours today, it didn't affect AMD that much from what I saw using Trading View. Now, it'll be interesting to see what happens when we open tomorrow. Will the news from Applied Materials all affect AMD even more, or is AMD's bad news from last week kind of priced in other bad news that could be coming down the pipeline, like from AMD, from Applied Materials today? It's a possibility, okay? So I just wanted to point that out. It looks pretty solid there, especially with today's acceleration from the bottom in the morning, rising throughout the day. Now I'm going to go back to the daily view here for AMD so you can see that, but I'm going to now switch this over to Applied Materials. Again, the ticker symbol is AMAT for Applied Materials. Now, why did Applied Materials hurt the semiconductor sector in the after hours today? Well, just like AMD, it lowered its guidance for Q3 due to new export regulations for U.S. semiconductor technology sold in China. That's what it is. The U.S. government is saying, hold up, your technology is way too good. We don't want it to end up in the hands of China's military apparatus. So, sorry, you cannot sell it to China. Now, Applied Materials also expects Q4 to see a similar impact from this new, what do we want to call it? Ban of technology being sold to China? That's what it looks like. So, This impact for Applied Materials, it sent them down 1.3% in the after hours, but it also brought other companies down with it. Now, before I mention those other companies, let's dive in. I know Applied Materials has been falling for 2022. I get that. But let's dive in here just a little bit closer. I want to look at the chart here. I want to open it up because I want to show you something here. I think I found something, at least doing a little bit of technical analysis here. So the summer rally, okay, let me get my highlighter so you can see that. The summer rally, Applied Materials, it rallied also, right? Then we had a double top form, and it has been declining ever since, right? Just like the rest of the market. Now, with that decline there, it's declining along, which is kind of interesting, the upper end of its trading channel. It's using that as support on its way down. That makes trading this thing a little easier if this continues to follow through, right? If this downtrend continues along that trend line, that trading channel that it was in all the way up to July of this year, if it does truly bounce right here, or at least start to consolidate sideways before making another leg down, that would make it interesting to trade in the short term. So I wanted to point that out to you. And you can see that it's been catching, you know, here it caught a bounce, here it caught a bounce, you know, even with the double top, it caught a bounce there too. But there was another trend line in effect at the first bounce that we saw there. And of course, before it popped out of that trading channel, this used to be resistance for Applied Materials. So again, it just adds a little bit more there to find that this trend line is a support line for Applied Materials. Now, I did find an interesting area, which is this blue box that I created right along here across the screen. It starts at about $69 a share, and it goes down to about $66 a share. So a very tight zone right there, but that could be the next big area of support for Applied Materials. Now, if we back this up here a little bit, and I want to go a little bit further back in time, you'll see what I'm anchoring this support to. So you can see it's not just a made-up area, but actually, if we go back here, okay, all the way back to February of 2020, right before the pandemic, we have that top right there. And then we go deep into the hole for March of 2020. We slowly start coming out April of 2020. And then we get to a top here of August of 2020 before another fall. So these two areas were very, very strong resistance areas. And what does old resistance do? It turns into new support. So as I believe, Applied Materials will continue falling at least, I don't know, another couple weeks before midterm elections. At least that's when seasonality has things kind of turn around. This could be the support area that Applied Materials really needs, because on the way down, as you can see here on the left side, when it went up, there weren't too many places where it pulled off to stop and consolidate to find areas that will support it on its way down. I mean, you can see this last time when it found this support here, and, you know, again, right here, that kind of lines up with that support right here, right? Okay, that makes sense. Old resistance can become new support. So we have that for Applied Materials. Now, one of the companies, let me clean this chart up here while I'm talking to you, that fell in the after hours was Intel. They fell right along with Applied Materials. And then we had KL Corp, ticker symbol is KLAC. They fell also on the news from Applied Materials. We had Lam Research, ticker symbol LRCX. And another one was Excelis Technology, ticker symbol is ACLS. Those are just a few names that fell in the after hours due to the information that Applied Materials put out in the after hours. Now, let's talk about today's trade. And when I get to the end of my notes, I have a very detailed, or at least I think it's detailed, talk about what to expect moving forward, like tomorrow and Friday to finish this week off. So I'm going to talk about that. And it can also come into play for the beginning of next week. So let's run through today. The S&P 500. Yeah, it found a new closing low today. Let's pull this chart up here so we can take a look at it. That, beginning of October rally, boy, it didn't last, did it? It was, the first trading day of October, which was October the 3rd, and then October the 4th, 2 great days of trading. That seems like on the seasonality chart. And do I have that seasonality chart pulled up here? Is this it? No, that's not it. That's my weekly expected moves. I'll have to pull that one up a little bit later on, but I want to move forward with this stuff. But this, it wasn't much of a rally, but this little rally right here, and then, of course, the fall off to a new low, that matches with the seasonality chart. And just to make sure that you're aware of, the seasonality chart for a midterm election year, just like we're in right now, the dates won't match up perfectly, but it's within, plus or minus a few days, and it has been matching up so far all year pretty darn well. Now, today's trade was mixed with little conviction on either side of the tape after disappointing PPI data, or the Producer Price Index data. The stock market opened with a modest loss, and let me go to the 5-minute chart here for the SPX, and we can talk about this. And again, I do have some a trading game plan to talk about. So here's the last 2 trading sessions, right? We had this low yesterday morning right here, right? We rallied, and then the afternoon had that big sell-off. Well, today we opened up pretty much where we left off yesterday, but we had a sell-off this morning that took us awfully close to testing yesterday's low at 35.68. And that's exactly where the S&P 500 caught a bid this morning, just to chop around all day and chew up market participants before finally selling off into the close and setting that new closing low for the year at 35.77. That is a new low for the year. And that's what we set. The SPY also set a closing low for the year at 356.56. Yeah, pretty lucky right there. The Qs did not set a closing low, and it wasn't much, right? It wasn't much of a closing low for the year today. Let's pull this back up so we can see it. What we were competing with is what was on the low on February 30th. And then, we got there. Just let's see, what was that closing low? 35.85 and 35.77. So not much. Now, the SPY, the Qs, and the IWM, they all ultimately closed with losses, but not that far off from the flat line. If we look at the SPY, down 0.33%. The Qs, down 0.03%. That's flat in my book. And then the IWM was down 0.27%. Now, the stock market proved to be fairly resilient, considering the hotter than expected September Producer Price Index market participants received this morning. Now, the producer price index was up 8.5% year over year, while core PPI, or producer price index, which takes out food and energy, was up 7.2% year over year, indicating inflation remains sticky at the wholesale level. Now, market participants also digested the FOMC minutes from the September meeting, which reiterated what Fed officials have been saying now for months about raising rates and keeping them there at a restrictive level for longer. Therefore, the FOMC minutes didn't contain any real surprises. That's why the market didn't really make any big moves up or down after they came out. Equities did take a small little step higher in the immediate aftermath, but they quickly returned to levels seen before the minutes were released. And then they, of course, headed lower into the close, setting a new closing low, 35.77. Now, the Treasury market, it did not have a big reaction to the PPI report either, and it showed some added improvement following the release of the FOMC minutes. The 10-year, let's pull that up. US10Y on TradingView. If you need a account for TradingView, there's a link in the description. Click on it, sign up. Doesn't cost a penny to use. Of course, they do have tiers though that you can sign up for, but it is free to use. Now, the 10-year here, like we have been talking about, it needed a cool-off period. It needed to pull back, reconnect with that 5-day EMA. So that's what it did. It fell 4 basis points to 3.9%, despite a disappointing 10-year note auction today that was just horrendous. Then the 2-year, US02Y for the 2-year yield. It fell 1 basis point to 4.29%. It's holding steady right now. It went through that expansion phase. Now it's in that contraction phase, getting ready for another expansion. But which way is it going to go? Expand up or expand down? That's the question. Right now, we don't know. We're waiting on CPI. And with the PPI coming in a little bit hotter than expected, what do you think that's going to do for CPI? I'll talk about that in just a moment when we get into a little more detail about trading tomorrow and the rest of the week. And of course, going into a little more detail about the producer price index. Now, I want to talk about Apple real quick. AAPL is the ticker symbol for Apple. Apple was down about 0.5% when it was all said and done today. Now, Apple was an important directional driver. It supported the market with its gains before losing steam later in the day and falling into negative territory, dragging the indices down with it. Whenever Apple moves up or down, it pulls the market with it. It is such a heavily weighted company in the entire stock market, and that's why it's good to pay close attention to what is happening with Apple. Now, another directional driver today was PepsiCo with their nice gain. Ticker symbol is PEP. Pepsi closed with a gain of 4.2% today after bucking the trend and posting better than expected earnings. And it raised its fiscal year 22 EPS guidance. Way to go, Pepsi. That's a giant boost in a market that was pretty much flat to slightly down today. Now, it did hit resistance at that 200-day moving average, and that's where it closed, right there on it, about 169. So, does it have the momentum to break above that? Wait and see, of course. It got way disconnected from its 5-day EMA. I do believe this will have to cool off, and it will have a pullback period before any other gains in Pepsi. Now, other factors driving price action today was, of course, the well-behaved Treasury market, barely moving at all, and a prevailing wait-and-see mindset in front of the Consumer Price Index report due out tomorrow morning. Now, the outsized gains in PepsiCo, it boosted the S&P 500 consumer discretionary sector today, ticker symbol XLP. And let's go ahead and pull the sectors up. Right-hand side of your screen here, you can see mainly red on your screen there. Not a lot of gains today, but the consumer staples sector, it was in second place today with that 0.5% gain. Now, energy, ticker symbol XLE, up 0.8%, sat in first place despite falling oil prices. Let's pull up oil. U.S. oil, real easy ticker symbol to remember when you're looking up oil. But WTI crude oil futures fell 2.2% to $87.22 a barrel on festering concerns about a global growth slowdown. I guess all the bluster about OPEC Plus and it slowing production are in the back of the minds of market participants now, and it's growth concerns that are front and center, driving oil prices to come down a bit after a pretty substantial run-up here in October. So what could that be doing to CPI? Not this time around, but next time around. Something to think about. Now, on the flip side of this, we've got utilities. Ticker symbol is XLU, down 3.4%. And real estate, XLRE, down 1.4%. They were the worst performing sectors of the day. Now, looking at today's economic data, we got the weekly MBA mortgage applications index. It fell 2%. Compared to that huge loss last week of 14.2%. Big drop last week, but that's not surprising. The housing market is slowing. Prices are dropping. Now, the producer price index, it rose 0.4% in September. The expectation was only 0.2%. So basically double the expectation from 0.2% to 0.4%. And that followed a revised 0.2% decline in August. And that revised 0.2% was actually worse than what was reported last month of only a 0.1% move there. Now, core PPI, and that takes out food and energy, rose 0.3% in September, and the expectation was 0.3%. So core did come in as expected. Now, last month, it was also 0.3%. So it seems to be a pretty steady move in core. And that's, again, you take out food and energy, which right now seem to be some of the most expensive things out there for consumers to buy, especially food. You know, whatever the CPI report says tomorrow about food, it's gone up and it is staying elevated. Inflation in food, you go to the grocery store, you're paying double, but that's not really showing up in the CPI report for some odd reason. Okay, just wanted to get that out there. Let's move on. With the PPI today, the key takeaway is that it shows producer inflation sticking at levels that will pressure profit margins in upcoming earnings. And it stoked concerns about negative pass-through effects to the consumer. If the price for the producer is staying elevated, then they're going to pass those costs right along to the consumer, which is going to keep the CPI report elevated as well. Now, in turn, that understanding will stoke concerns that there has not been enough improvement on the inflation fight to convince the Fed to take a more guarded approach when it's considering how far to hike rates. So, not looking good. Now, the market held up pretty well today, only being down 0.3% with that overinflated, producer price index. Now, looking ahead to Thursday, market participants will receive the September Consumer Price Index report. The expectation is 8.1% on the year, 0.2% month over month. Now, the prior month was 0.1%. And then core CPI, which again takes out food and energy, just like the producer price index, the expectation is 0.4%. The prior month was 0.6%. So a little slowdown there. Could that be a sign that inflation is going to tick up tomorrow? We'll obviously have to wait and see. Nobody's got the crystal ball. Although the sell-off after a choppy day in the markets at the close today, setting a new low, is it market participants thinking, well, with PPI coming in hotter than expected, CPI will too, let's go ahead and sell? Or is the market oversold enough to compensate for a tiny overheated CPI report? Obviously, we don't know, right? We won't know until tomorrow. But CPI, that's what we were talking about. But along with the CPI report, we're also going to receive the weekly initial jobless claims. The expectation is 225,000. The prior reading was 219,000. So an uptick there. And then continuing claims, there is no expectation, but the prior reading, that's all that we go off of. The prior reading last week was 1.361 million. Now, all these reports drop at 8:30 a.m. Eastern. So we got a little time to digest it before the market opens. Now, for the remainder of the week, let's talk about the mentality here, how do we work this, right? How do we work this trade going on? Playing both sides. Just caught that comment there. Yes, playing both sides is a good strategy going into tomorrow, when we are obviously unsure. We don't have the numbers. The market setting a new low today kind of makes you think that, well, market participants are thinking that it's going to be hotter than expected. Well, whether CPI data comes in hot or not, sellers remain in full control of this market simply because they can. The price trends remain in a persistent down channel for the majority of the indices and sectors, reflecting all of the geoeconomic concerns and uncertainties that swept the headlines on a daily basis. There are new headlines out there. So the sell first, ask questions later mantra continues to ring true. While many doom and gloom scenarios keep emerging, bulls are repeatedly kicked back to the sidelines after each attempted rally. Earnings season is also getting underway. So many a contrarian is hoping that the expectation bar has been lowered enough to stabilize price action in the coming weeks. And again, seasonality chart says that after this dip, once we get past midterm elections, we should have smoother sailing into the end of the year. Whether that holds true like it has thus far this year, we're going to have to wait and see. Because we remember, with that seasonality chart, it's a historical look going back to the 1940s, and it also takes into account the midterm election cycle as well. So the back half of October tends to create a pivotal bottom for equities during this midterm election year. Now, you combine that with extreme negative readings in both sentiment and breadth, and the potential for a rally could obviously be brewing. It is brewing on the seasonality chart. We're only a few weeks to a couple of weeks away from that rally potentially taking shape. However, the burden remains on buyers to start overcoming key resistance zones. So the bottom line is the trends remain down, favoring the most nimble of traders that buy low and sell high under these choppy, volatile markets. The door remains wide open for sellers to aggressively take down prices in a come on. I'm getting my words twisted there. I'm feeling it right now, right? Let me back up here and put this in. Let's get this out. The door remains wide open for sellers to aggressively take prices down in a climatic fashion to finish a new yearly low. So tight risk management remains a top priority. Don't let risk get away from you. All right, good question here. What stocks are you looking at to go long if the CPI print is bullish? Well, that's definitely an interesting question. So I haven't mentioned this in a few months, probably. It's been a while because we've just been sinking further and sinking further. Again, I probably haven't talked about it since the summer rally. You should have a list of stocks that you want on your shopping list. So when this market finally does reach a bottom, whether that happens in the next few weeks, we get a bounce into the end of the year, or we just sink for the rest of the year, and then maybe next year will look better. But I kind of think that within the next few weeks, we're going to find a 2022 bottom. And then we're going to rally. It doesn't have to be a big rally like the summer rally, but we're going to rally into the close of the year. However, in 2023, I think we'll set a new low in the S&P 500 that undercuts the 2022 low. Now, I know that's not on your topic with your question there, but I did want to bring that forward. I've started to do my market thesis for 2023. It won't be finished anytime soon, but I'm kind of seeing that as a potential path for this market. I see your update there. You meant trades. Okay. What I'm trading is not individual stocks if we get a bullish rally for CPI. I am strictly on the Qs and the SPY. That's it. That's the only two things that I'll be playing, whether we're bullish tomorrow or bearish. But I need to see that direction be moving. I don't want to see what happened today or yesterday with it just chopping around and chewing up market participants. I want to see a significant move up or move down. And whichever way it's going to go, the SPY and the Qs, I'll either go long on SPY, long on Qs, a little bit more emphasis on the Qs because they've been beaten down more. They'll probably have more of a rally than the SPX, the SPY will, just due to earnings season and the banks and the financials, which have a very heavy weight on the S&P 500. So whether you're playing the SPY or the SPX, you got to keep that in mind. Those bank financials are going to start coming out tomorrow and Friday, and they can hold back the S&P 500 while the NASDAQ, so the Qs, they won't have that same tugging pressure holding them back if the banks come up short, okay? So more into the Qs, but also in the SPY. And I'm going to go long or short whichever direction the market is going to take it. That's the only two ones that I'm playing tomorrow. Now, as far as if we go back to your question and look at once we do find a bottom, if we do, like I think in the next few weeks before, kind of rallying into the close of the year, and again, it doesn't have to be a summer rally where it was just boom, we had it and it was gone. Nice rally. But something that is at least up and to the right on the chart. Have a shopping list of companies that you want to buy. Ready to go. You've already vetted them. You've already researched them. You've already done your due diligence. And you've already looked at the chart to find support areas, support zones for those companies. Once you've done those things and they're on your list and you have your price point written down, or at least a price point zone written down, then once we find that bottom, start to nibble. Start slow and start small. Some companies that are on mine, I would love to have Alphabet. I think that's getting really beaten down. Microsoft keeps going down. Small caps, SoFi, definitely looking to add more of a long position in SoFi, because small caps, remember, they have a greater potential of a short squeeze happening. And short squeezes, they're not just a one and done thing. They can reload every time the market is going down. So that's just a couple off the top of my head. I do have a list written down. Enphase is one that I want to see that one pull back some before I jump into it. But Enphase is one. Generac is another one. I love that company. But one thing to watch out for is if we do go into a recession, a company like Generac, who the majority of their business is in the residential sector, once housing prices start going down, consumers start spending less, and that could affect their business. So that's on there. My goodness, there's so many. Maybe one of these live streams coming up when we get closer to a potential bottom for 2022, we can do a segment on the stocks that I have on my list. But that's a few that's off the top of my head that I'd love to get my hands on once this market does start to find its bottom. And it could be in that process right now. That may take a few weeks to finally get through and before we see that rally. As a matter of fact, let me pull up that seasonality chart before we wrap things up here. Let's see here. I want to go over here, pull this up. Let's just get that seasonality chart real quick. I love looking at that thing. All right. It's loading now. It's the same chart I've shown many times here on the live stream. Oh. So we are in the red line, okay? The black line at the top, that is all years from 1946 through, I believe, it was 2021. Then the red line follows where we are currently in the second year of a new Democrat Party president's term for midterm election year, okay? That red line has been spot on all year long. Let me just pull this out here real quick. Get a big... All right. So the summer rally, which was right here, it got that nearly perfectly, right? The middle of June all the way up to the middle of August. And then the pullback that we experienced from there all the way to the middle to end of September And the September low right here also was undercutting the June low right here, which happened. So looking forward here, it said the first half of October, we have this little rally. But then the back half of October going into midterm elections, we have a sell-off, and that sell-off takes us to a new low for the year. And then after midterm elections are over, we'll have a little pop and then a little sell-off. Once we get to maybe Thanksgiving time, we'll start to rally into the close of the year. So this is the game plan right here. You see it just as clearly as I do here. That red line is my game plan for planning this market, because it has been pretty spot on all year long. So just want to point that out again. I've done it many times before, just so you can see that kind of time frame. Now, again, when you're looking at the time frame, obviously it looks like middle of October to the end of October, a big drastic drop. And if we come in hot with inflation tomorrow, we'll definitely see a big drop. If the Fed happened to do an emergency meeting, because remember, there is no FOMC meeting in October, but if the Fed did an emergency meeting where they had to hike rates because CPI came in way too hot, that would also cause a drastic drop in the market. So just a couple things to be aware of. Again, it's calling for a new low for 2022, actually the low for 2022, sometime towards the end of October. And it can be off. It doesn't have to be exactly right there. That's why there's no exact date along the bottom. So it can move, a few days beforehand, a week beforehand, maybe a week after or so. So it's not rigid. It's not firm in that sense. It can slide around a little bit, but it has been so spot on this year that I have to consider it. At least I have to put even if it's a tiny little weight, I have to put a tiny little weight on this prediction right here, which could be totally off, but I have to put some sort of weight on it because it's been so accurate thus far this year. So we got that there. Okay. Another drop would be nice. Yeah. We got a new low today for 2022, which would be, today's the 12th. That would be a couple of weeks a bit earlier than what that chart is showing, but that could happen, right? But again, a couple of scenarios there. Hotter than expected CPI report tomorrow, emergency Fed meeting. And I don't think there's going to be an emergency Fed meeting. So I'm just throwing it out there as a what if type of thing. Those two events would drop this market hard, right? So we just have to be patient. Our risk management has got to remain tight, and we got to stay on it, because you can easily get chewed up and spit out. Today is a perfect example of that, where the market just up and down, up and down, up and down, right? It can just drive you crazy. So that's why I would like to see a little bit more of a firmer direction tomorrow because of the CPI report. And again, with the producer price index coming in hotter than expected, those prices get passed along to the consumer. So if you're thinking logically here, CPI is probably going to be a little hot tomorrow. And I've seen a couple of estimates that point at about maybe an 8.3, which is where it was last time around on a yearly basis. The yearly expectation is 8.1%. So an 8.3, the market's not going to like that if that's what happens. I even think that if inflation is right on expectation, I don't think the market's going to like that either, because that just means, you know, the Fed's going to continue to hike. But if it's at expectation, then maybe the market will just chop around like it did today, and we won't get a directional move one way or the other that's at least significant. Significantly enough that we don't just chop around. The chop, I don't want to be in the chop. I'd like some direction, whether it's up or down. Right now, it doesn't matter to me which way it is. I would just like something other than the chop. We got to shake more people out so I can do another round of shopping. Yeah, see, that's another thing too. We have not seen capitulation. You know, there are plenty of YouTubers out there. Oh, capitulations happened. You know, capitulations happening right now. I can see it as a thumbnail. I have not seen capitulation yet. Capitulation is when the VIX spikes into the 40s. We haven't gotten out of the 30s since 2020, March of 2020. That's capitulation. I just haven't seen it yet. This has just been a bear market where we're just going down little by little, have these little pops of rallies. But yeah, something a little more directional is something I would like to see in the market. And capitulation, you know, if you look at that seasonality chart, the reason it's kind of like a straight line down there at the middle to end of October is because of capitulation. So if we see that, I'll love it. And I'll definitely be pointing that out to you guys. And if any of you who are watching and you didn't know, 2 o'clock is when the FOMC minutes came out. By 2:14, our private investor community had the notes on that. So turn that around quickly. And if you want to join our private investor community, ton of information to help you along your investor journey, whether you're investing or trading, new or pro at it. The information can help. Just click that first link in the description. And why I'm saying that, also do me a favor and click that like button. Share this video with a friend. Those two things greatly help out a small channel like this. Okay. Well, that's everything on my notes that I wanted to go over and talk about today. A little bit late because I wanted to look into the semiconductor stuff that was happening in the after hours. So that's why I got that front and center when we started the live stream today. So if you didn't catch that, back it up, check it out. Applied Materials came out, lowered guidance, said Q3, Q4 are going to be the same. All because of the restrictions being placed on them by the US, saying, hey, your technology is too good. You cannot sell it to China because we don't want it ending up in the Chinese military. So I can understand the national security concerns. Technology is getting pretty darn smart, but that will hurt companies one way or another. Okay, so if you have any questions, throw them in now. Otherwise, I'll see you tomorrow after the market closes to talk about what happened, why it happened, and what to expect moving forward. CPI, that's the big one tomorrow. 8:30 a.m. Eastern is when the numbers drop. Investor community on Patreon and in Discord, you'll get a note on that as soon as we can turn that around. We'll dive into it, try to figure it out as quickly as possible, and then get that out to you guys. Do you think do you think a very good CPI print will overpower bad earnings? No, but I think it would be a wash in a sense that we're not going to go anywhere. Good CPI means inflation is coming down. Good CPI, the market rallies. Good CPI, and a lot of market participants will focus on that tomorrow. So whatever earnings do come out tomorrow, and I guess I should rephrase my answer there a little bit. A good CPI, like a 7.8, 7.7, that range, good of a CPI report, and I just don't see that right now. But if that were to happen, this market would rally. It would take off. And that would overlook any earnings that are bad tomorrow. Now, the individual stocks that do post earnings tomorrow, if they are bad, that individual stock would get hammered. But as far as the overall market, if half the financials are good, half the financials are bad, then it's going to hold back the S&P 500 a little bit, but that's it. Qs will rally, IWM will rally, it'll be just fine. But the SPX and SPY, it'll be held back a little bit because financials are such a heavy weight. It's one of the heaviest. Financials, energy, those are two big dogs out of the 11 S&P 500 sectors. So they've got a big weight and a big pull on the SPX and the SPY. But in the longer term, if inflation is coming down, a good CPI report, maybe next month we have a good CPI report, I think that would be an overall wash if earnings were bad, right? So these earnings that are kicking off now, the Q3 earnings, I think they'll be mixed. The Q4 earnings, I don't think they're going to be that great. Q1 2023 earnings, I don't think are going to be that great. Q2 of 2023 earnings, I'm not sure about yet, because that's too far out. But I do think midway through 2023, I don't even know if I want to say, because that's so far out. I'll hold my thoughts on that, going that far, because that's just too far out. Applied Materials, opinional news. We did talk about Applied Materials at the very beginning of this live stream. So you can back that up if you want to check that out. But basically, Applied Materials is being put into a squeeze, a corner, because of the U.S. government. With the Applied Materials cutting their guidance, saying that Q3, Q4 are going to be hurt the same across the board, that's too bad, right? That's bad for Applied Materials. AMAT is the ticker symbol there. Now, the U.S. government basically saying, okay, your technology has gotten so good, and we're getting a little bit nervous of China. You can't sell your technology to China because we don't want it to accidentally end up in the hands of the Chinese military. So we're going to put restrictions on what you can and cannot sell to China. That's what's happening to Nvidia, AMD, Applied Materials, a whole bunch of them. The semiconductor industry, it's being hurt right now. All the components, because of this, especially US-based semiconductor components. This isn't going to get any better. If anything, this is going to continue to escalate. So what Applied Materials is coming out and saying today, in the after hours, mind you, is that things are going to get bad, and we don't see the light at the end of the tunnel yet. So while they are predicting the next 2 quarters to have problems, it could be the next 3, 4. Who knows how many quarters that they're going to have problems because of the restrictions. I mean, the restrictions now, they could only increase and get worse. As the technology improves and as the technology gets better, the restrictions are only going to intensify. So we might have to take US-based companies in the semiconductor, the chip space, all the different components within it, and get a new reference point and have to set new expectations for them going forward. That, hey, these limitations are going to be here because the national security situation isn't going to change. So just a few quick little thoughts there on Applied Materials and the semiconductor industry as a whole. I'm gonna pull up here real quick what the actual numbers were that Applied Materials mentioned. Just give me a quick second. So this can load here. Okay. It's loading. And so I can give you the exact numbers that Applied Materials put out. And it's taking its good old time, as usual. Okay, here we go. Almost there. One more little box has to load, and it's the box that's got that information in it. Come on. You can do it. And we've got all the way to November 17th before their earnings. Okay, so EPS of $1.54 to $1.78, and that excludes non-recurring items, versus the $2.01 expectation. Revenue, 6.15 to 6.65 billion versus 6.67 billion expectation. The company estimates that the new regulation will reduce its Q4 sales by $250 to $550 million. That's a good chunk of change for a $6.1 to $6.6 billion quarter. Now, the EPS outlook includes the impact of lower expected revenue, along with a preliminary estimated impact of approximately 23 cents. Okay? EPS is expected to be $1.54 to $1.78. And if the estimated impact is 23 cents a share, that's a significant impact, right? And they say it's mainly for inventory and remanufacturing charges related to the new export regulation. Company currently expects the new regulations will impact net sales in Q1 by a similar amount as in the current quarter. So not looking good there. Not looking good at all. New PC after this bear market. Absolutely. Oh, I totally forgot that question was up on screen. My apologies. I should have swung your question up there, since that's what we were just talking about. And then, of course, after this bear market, a new PC, and ditch the Pixelbook for live streams. I still like the Pixelbook though, so don't get me wrong on that. It's just not the right tool for live streaming. But I still like it. It's quick. It's easy to port. The portability is just awesome. But anyways, that's off topic. All right. Any other questions, or is everybody okay and ready for tomorrow? Give you a minute to do that. And while you're plugging any last minute questions you may have, if you could click that like button, share this video with a friend. Those two things greatly help. They greatly help a small channel like this. Another thing that helps too, it's a little harder to do, but if you could leave a comment on the actual video, not just here within the live chat, that also helps too. Anything to help get this video to break that YouTube algorithm. It sucks to ask and say these things, but yeah, I guess it's part of the YouTube game, right? All right. And just as a reminder, if you like the perspective, you want more, a lot more, I must add, click the first link in the description and come join us. I'd love to see you there. Okay, well, we'll go ahead and wrap it up then for tonight. If there's no other questions, be ready. Be ready. Could we see a choppy day? Okay, here we go. I'll throw this up here. Thumbs up. Awesome. Awesome. I'll get that up here in just a moment on the screen. Could we see a choppy day tomorrow? I would close my puts and calls if that would be the case. If expectations are met, then I think we end up with another choppy day. Expectations that are met means inflation is still in the 8% digit. That's still not good. The Fed will still act. The Fed will still raise rates. The Fed will still continue to tighten. $95 billion coming out of the market every single month. That's liquidity that, for a company like Applied Materials right here, that's liquidity that's going to be taken away from that company. That's liquidity that's going to be taken away from the S&P 500. That's liquidity taken away from the NASDAQ. That's liquidity coming out of the entire market. When money comes out of the market, when investors sell, the market goes down. So I don't see a big directional move unless we come in under and we're in the 7.8, 7.7% range. I don't personally see that. It's always a possibility or a probability. I just don't see that happening. If that happens, the market's going up and it'll have a big move. JP Morgan Chase, they say the market can move 5% tomorrow on CPI. And they think that CPI is going to come in hot, meaning a 5% move down. If that were to be the case, that means the expectations were not met. Inflation was hotter than the 8.1% yearly expectation, and the market will drop. But I think if it meets expectations, that's like, okay, so what? We know what's going to happen. We have the playbook right now. We know the Fed is going to raise rates. We know the Fed's going to tighten. We get it. We're just going to chop around. That's my feel on it. Now, I don't always get it right. So as long as you're researching too, you should do all right. As far as your calls and puts, you're riding this thing for either way, ready to go. We can't be right on expectation. Otherwise, just like today, slightly hotter than expectations and the market chopped around. I don't like the chop. You can scalp trade the chop. I mean, when the market's going up, as long as you're buying at the bottom, selling at the top, you can make money in a choppy market. It's just not I don't like those types of markets. There are traders that do. You can make money in a market that is choppy like today. I just don't like to do it. Maybe I'm not confident enough with myself about a choppy market that's like this, because that chop can easily look like yesterday, where you have these big run-ups and run-downs, all because of headlines. I mean, yesterday, it wasn't even because of what was happening in the US. It was what was happening in the UK that caused yesterday's moves. For the most part. There was some Fed speak, but yeah. So I could see a choppy day tomorrow if we're right on expectations, because it's like, we've seen the story. We know what's going to happen. The same thing. And we've already pulled back a bunch. We're not at an oversold level quite yet, but we're getting there. We're at a 34 on the RSI. 30 and below, that's oversold. So we're not there yet, but we are headed there. And another thing to pay attention to is the weekly expected move. I know I'm going over what I just said I would, but the weekly expected move, we got to pay attention to where that's at. It is basically sitting right on the 50% retracement level, which is right about 3,500. There should be a lot of support at 3,400. I'm sorry, 3,500. There should be a lot of support. 3,500 for the SPX or S&P 500. That would be 350 for the SPY. That should be a support level. It has all the technicals lining up perfectly, just like all the technicals lined up perfectly for the top of the summer rally. There were 3 different technical indicators saying that was the top. Right now, there are a few different indicators saying that 3,500 is a significant level that we should see support. And maybe that's the low of 2022. Maybe. I'm not going to call that, but it could be, because there should be support there. You are welcome. I hope that there's a big move as well. I do. Absolutely do. Okay, let's get the thumbs up there. Don't want to miss that one on the screen. Okay, well, I'll wrap it up here. Thank you guys so much for joining me. Be back tomorrow after the market closes, talk about what happened, why it happened, and what to expect. And of course, our investor community on Patreon and on Discord. You'll hear from me throughout the day tomorrow. And if you would like to join our private community, just click the first link in the description. Right there, ready to go. Game day tomorrow. Absolutely. I like that. Game day tomorrow. Let's get it. Let's get it. All right. So you guys have a wonderful rest of today, and good luck tomorrow with your trades. And